Every generation believes their saving strategy will work because it worked for their parents, and this belief persists right up until the moment the rules change, and the rules always change during crises, not randomly, but according to patterns that have repeated throughout monetary history, patterns where institutions adapt to protect themselves, while individual savers discover that the safety they assumed was guaranteed was actually conditional, contingent on circumstances remaining stable. And stability, as history demonstrates with uncomfortable consistency, never lasts as long as people expect it to. What I want to show you today isn't a prediction about what will happen to your savings. It's an examination of what has happened to savings during every major financial crisis in modern history, and more importantly, why it happened, what mechanisms were used, what legal and institutional adaptations occurred, and why those same mechanisms still exist today, embedded in the financial system you participate in, waiting dormant until the next crisis activates them, because that's how systems work. They don't eliminate risks, they transfer them. They don't prevent crises, they manage them, and management always means deciding who bears the cost. And if you study the historical record with any honesty, you'll see that the cost is consistently borne by the same group of people, the savers, the ones who trusted the system and played by the rules and believed their prudence would be rewarded. Let me take you back to 1933, to the depths of the Great Depression, when approximately 9,000 banks had failed across the United States over the previous 3 years, and millions of Americans had lost their savings not because they made bad decisions, but because the banks they trusted had made bad loans and engaged in speculative investments, and when those investments failed, the depositors paid the price. And this wasn't a natural disaster. This was a system failure, a failure of fractional reserve banking that created money through lending but couldn't honor withdrawal requests when confidence evaporated. And the government's response to this crisis established a pattern that would repeat for the next century, a pattern where the solution to a crisis caused by excessive debt and leverage is always more debt and more institutional control, never less. President Roosevelt declared a bank holiday, closed every bank in the country, gave people no access to their money for days, and when the banks reopened, the rules had changed because the government had established the Federal Deposit Insurance Corporation to guarantee deposits, which sounds like protection for savers, and in some ways it was, but it was also protection for banks, because FDIC insurance meant people would keep their money in banks even after those banks had proven untrustworthy, and the cost of this insurance wasn't borne by the banks that created the risk. It was socialized, spread across all depositors through various mechanisms, and this established a moral hazard where banks could take risks knowing that the downside would be absorbed by the system rather than by bank shareholders, and this moral hazard would grow larger and more dangerous with each passing decade. But the 1933 reforms did something else that's less discussed, but more relevant to understanding how crises affect savings, because along with creating deposit insurance, the government criminalized private gold ownership, required citizens to surrender their gold at $20.67 per ounce, and then revalued gold to $35 per ounce, which meant the government had effectively confiscated roughly 40% of the wealth held in gold. And the justification was emergency, was crisis management, was the necessity of reflating the economy. And maybe those justifications were even sincere, but the effect was undeniable. People who had saved in the hardest, most historically reliable form of money had that money taken from them by legal decree, and this established a precedent that emergency powers could override property rights, that crises could justify confiscation, that the rules protecting your savings were not absolute but conditional. Now fast forward to the 1970s, to a different kind of crisis, not a banking collapse but an inflation crisis, and this crisis teaches a different lesson about how savings fail during systemic stress, because the inflation of the 1970s wasn't an accident or a natural occurrence. It was the inevitable result of decisions made in previous decades, decisions to disconnect the dollar from gold in 1971, decisions to finance government deficits through money creation, decisions to prioritize short-term economic stimulus over long-term currency stability, and these decisions were made by very smart people who understood the risks but believed they could manage them, believed they could fine-tune the economy, believed that modern economic theory had solved the ancient problem of currency debasement, except it hadn't, and the result was that people who had saved dollars for retirement watched those dollars lose more than 60% of their purchasing power over the course of a decade. And here's what makes this particularly instructive. The inflation wasn't framed as theft. It was framed as an unfortunate side effect of necessary policies, and the people who suffered the most were the people who had done exactly what they were supposed to do, the people who had saved in bank accounts and bonds, the people who had trusted that the dollar would maintain its value, the people who didn't own real estate or stocks or other assets that could appreciate nominally even as the currency debased. And this revealed something fundamental about how modern monetary systems operate, which is that they're designed to favor debtors over creditors, borrowers over savers, asset owners over wage earners, because inflation reduces the real value of debt, which benefits governments drowning in obligations and banks that profit from lending, but it destroys the real value of savings, which harms ordinary people who don't have access to the same financial strategies that institutions use to protect themselves. If you're starting to see a pattern here, if you're beginning to understand that savings fail during crises not randomly but systematically, not because of individual mistakes, but because of how the system is designed, then you're ready to understand the next layer. And if you haven't subscribed to this channel yet, this is the moment to do it, because what we're documenting here isn't entertainment. It's a systematic examination of how financial power operates, how institutions protect themselves at the expense of individuals, and how historical patterns that destroyed savings in the past are being recreated in the present under different names with more sophisticated mechanisms. The 2008 financial crisis offers perhaps the clearest example of how the system adapts to protect itself while transferring costs to savers. Because when the housing bubble collapsed and major financial institutions faced insolvency, the government and Federal Reserve made a choice. They could have let the banks fail and allowed the market to clear, which would have been painful and chaotic, but would have punished the institutions that took excessive risks. Or they could bail out the banks using taxpayer money and Federal Reserve money creation, which would protect the institutions, but would transfer the costs to everyone else through taxes and inflation. And they chose the second option. They always choose the second option, because the people making these decisions come from the financial sector and return to the financial sector, and their entire worldview is shaped by the assumption that major financial institutions must be preserved regardless of cost. The Federal Reserve created trillions of dollars through quantitative easing, purchased toxic assets from banks at inflated prices, held interest rates at zero for years, and all of this had a predictable effect. It inflated asset prices, which benefited people who owned assets, primarily the wealthy, while punishing savers by giving them zero return on their deposits and negative real returns after accounting for inflation. And if you were a retiree in 2008 with your money in safe, conservative investments like bonds and savings accounts, you watched helplessly as your retirement income disappeared, as the interest payments you had planned to live on dropped to almost nothing, as you were forced either to take on more risk by buying stocks at elevated prices or to slowly deplete your principal. And this wasn't an accidental side effect. This was explicitly intended policy, because Federal Reserve officials openly stated that they wanted to force savers into riskier investments, that they wanted to push money out of safe assets and into risk assets. And the fact that this policy destroyed the retirement plans of millions of prudent savers was considered an acceptable cost of saving the financial system. And here's where the system's adaptation becomes truly insidious, because after 2008, after the public outrage over bailouts, using taxpayer money, policymakers decided they needed a different mechanism for the next crisis, something that wouldn't require congressional approval or generate visible political backlash. And the mechanism they developed is called bail-in, and it's now embedded in banking regulations across the developed world, including the United States. And a bail-in means that instead of using government money to rescue failing banks, the banks are recapitalized using the funds of their creditors. And as we discussed in the previous video, when you deposit money in a bank, you're legally a creditor, not a customer storing property, which means your deposits can be converted to bank equity in a resolution process, and this has already happened in multiple countries. It's not theoretical, it's tested and proven, and the legal framework exists in United States law through the Dodd-Frank Act's Orderly Liquidation Authority provisions. Now let me connect these historical examples to the present moment, not to make predictions but to observe structural similarities, because the United States federal government currently carries approximately $35 trillion in debt, which represents roughly 125% of annual economic output, and this debt is growing by about $2 trillion per year, and the interest payments on this debt are consuming an ever larger portion of the federal budget. And these are not opinions. These are documented facts from the Treasury Department and Congressional Budget Office, and the mathematical implications are straightforward, even if the political implications are denied. At some point, the debt becomes unsustainable. At some point, interest payments exceed the government's ability to pay them from tax revenue alone, and at that point, the government faces limited options. It can default explicitly by refusing to pay, which would destroy the dollar's reserve currency status and collapse the financial system, or it can default implicitly by inflating the currency, by creating money to pay debts in dollars that are worth progressively less, which is politically easier but economically devastating to anyone holding dollar-denominated savings. But there's a third option that's increasingly discussed in international financial policy circles, and that option is financial repression, which is a technical term for policies that force savers to accept below-market returns so that governments can finance themselves cheaply. And financial repression takes many forms. It can mean holding interest rates below inflation so that government debt becomes easier to service while savers lose purchasing power. It can mean regulatory requirements that force pension funds and insurance companies to hold government bonds regardless of return. It can mean capital controls that prevent money from leaving the country. It can mean wealth taxes or mandatory conversions of retirement accounts into government annuities, and all of these mechanisms have been used in various countries during periods of high government debt, and all of them transfer wealth from savers to the government, and all of them are legal under existing frameworks if implemented during declared emergencies. And this brings us to the central insight that explains why saving money fails during every major crisis. It fails because the system is designed to prioritize institutional survival over individual property rights. And this isn't a conspiracy, it's not hidden, it's openly discussed in policy papers and academic journals and central bank documents, because from the system's perspective, individual losses are acceptable if they prevent systemic collapse. And this logic has a certain brutal rationality to it, except that it means ordinary savers are always the shock absorbers, always the ones who bear the cost of systemic mistakes they didn't make. And if you understand this, if you internalize that your savings exist within a legal and institutional framework that can be modified when authorities decide it's necessary, then you understand something that most people never learn until it's too late to protect themselves. The pattern across all these crises, from 1933 to the 1970s to 2008 to the present, is that saving money in traditional forms, in bank deposits and government bonds and cash, fails to preserve purchasing power when the system faces stress. And it fails not because savings are inherently flawed, but because the institutional response to stress always involves mechanisms that devalue or restrict or confiscate savings, whether through inflation or bail-ins or emergency powers or financial repression. And the reason these mechanisms target savers specifically is that savers are politically weak. They're dispersed, they're not organized, they don't have lobbyists, they can't threaten to withhold campaign contributions, whereas banks and large institutions are politically powerful and can credibly threaten systemic collapse if they're not protected. So the political economy of crisis management always resolves in favor of institutions and against individual savers. Now, you might be asking what you're supposed to do with this information, how you're supposed to protect yourself when the system is designed to transfer losses to people like you, and that's a reasonable question, but it's also the wrong question, because the right question isn't how to achieve perfect safety, which is impossible. The right question is how to reduce your dependence on a single system, how to diversify across different types of assets and different jurisdictions, how to understand the risks well enough to make informed trade-offs, rather than blindly trusting that institutions designed to protect themselves will somehow protect you too. And this is where education becomes crucial, because the sophisticated approach isn't to panic and liquidate everything. It's to understand what each type of asset represents in legal and institutional terms, to know the difference between direct ownership and beneficial interest, to understand which assets can be confiscated or restricted easily and which cannot, to know how different assets perform during inflationary periods versus deflationary periods versus periods of financial repression. And this knowledge isn't taught in schools. It's not provided by financial advisors who earn commissions selling you the products that benefit them. It's knowledge you have to seek out independently, knowledge that comes from studying history and understanding how systems actually work rather than how they're supposed to work in theory. I want you to think about your own situation, about where your savings are held and in what form, about whether you understand the legal terms under which you hold them, about whether you've diversified across different types of assets, or whether you've concentrated everything in traditional retirement accounts that come with restrictions and penalties and tax consequences that reduce your flexibility. And I want you to ask yourself whether the strategy you're using is based on your own analysis of risk, or whether it's based on assumptions inherited from a different era, from a time when the system was structured differently and when debt levels and demographic pressures and political instability were not what they are today. And I want you to leave a comment telling me which of these historical crises surprised you most, which mechanism you weren't aware of before, which pattern you see repeating in the present, because these conversations matter, because the more people who understand how the system actually operates, the harder it becomes for institutions to implement policies that benefit themselves at public expense. And while individual comments won't change systemic dynamics, collective awareness does shift political possibilities, does make certain policies harder to implement quietly, does force more transparency and accountability. If this video has deepened your understanding of how financial systems operate during stress, if you now see patterns you didn't see before, if you understand why traditional saving strategies that worked for previous generations may not work during the crisis phase of a debt supercycle, then you need to subscribe to this channel immediately and turn on notifications, because we're systematically documenting the mechanisms of financial power, the historical patterns that repeat, the legal frameworks that exist, the institutional dynamics that determine who bears costs during crises, and this information is essential for anyone who wants to navigate the next decade with their wealth intact, because that decade is going to test assumptions that have held for generations, is going to activate mechanisms that have lain dormant since the last major crisis, and the people who understand what's possible, what's legal, what's happened before will be far better positioned than the people who trust blindly and assume stability. The next video in this series is going to examine something even more specific and immediately relevant. We're going to look at the exact legal language in retirement account agreements that allows administrators to modify terms, to restrict withdrawals, to change investment options during periods of market stress, and we're going to show you what happened to retirement accounts in countries that experienced currency crises, what restrictions were imposed, what losses were taken, what legal justifications were used, because your retirement account is probably the largest concentration of your wealth, and if you don't understand the terms under which you hold it, if you don't know what's possible under existing law, then you're vulnerable in ways you don't recognize. So make sure you're subscribed, make sure you watch that next video, because the gap between what people assume about retirement security and what's legally possible is wider than most people imagine, and closing that gap through education is the only real protection available.